The fall of African Bank didn't just expose vulnerabilities of unsecured lending, but it also puts emphasis on where pension funds invest your money in search of better returns. They take risk on your behalf. Do you know about that risk? Do you care about that risk? Until it all goes wrong, of course. Then suddenly everybody starts caring. This is Tonight. I'm Bruce Whitfield. I'm joined in Johannesburg by Johan Gouws, who's the head of Absa's Asset Consulting Unit, and in our Cape Town studios, Stephen Nathan, the chief executive of 10X Investments. These are index trackers that Stephen Nathan focuses on. When we look at it, John, just give me a broad sense of the exposures of different asset classes to African Bank.
Right, so first of all, you would have had your equity component where you just bought into the able share, and then some of these asset managers would have been buying into subordinated debt or senior debt, and depending on what kind of mandate you had as an asset manager, you would have then had exposure to either one of the two or both of them, maybe in a multi-asset class type of portfolio. To give you an idea about the total amount of exposure of the industry as a whole, very difficult to do. I think when you talk about exposure, does the exposure to equity let's say at Friday, does it matter because it was worth nothing? I think the greater focus right now is the exposure to the senior debt, where we know that there's a haircut of 10% on that, as was announced by the SARB on the weekend. So I think right now, as we're sitting here, a lot of pension funds just trying to get some of the answers from the asset consultants in terms of exactly what was our exposure, what does this mean for us going forward, and I don't think anybody could really comment on a sensible way on what has been happening until Sunday's announcement by the SARB, and then also the decision by CISA on Monday also about how they're going to deal with this, where pension funds are invested in collective investments. That's
the one part of it. And I've also been getting emails from people telling me that money's vanished out of their money market funds at Absa. It may have happened across other banks as well, but I've only had emails about Absa. Why has money actually been taken out of people's money market accounts? I understand that the yield drops on the returns, but yes, physical cash has been removed from money market accounts.
So I think the first principle was that they decided they don't want to do this adjustment, and this is an industry decision. They didn't want to do this adjustment over time by reducing the yield. They wanted to have a once-off effect and get it out of the system. So the way in which you would do that is by, first of all, you'll drop your yield to zero, which happened for all the money markets pretty much on the Monday. Okay. And if there was still in excess exposure to able that you had to basically adjust for, then you would do a once-off adjustment to the valuations as well. Now, because a unit trust fund has a unit price of 1, you couldn't really reduce the value of the unit price. So you had to physically reduce the number of units that investors had. And I think the one thing that maybe went wrong is the communication or lack of communication that happened.
There was zero communication.
Prior to that.
People woke up to money gone.
Absolutely, and I think that is where it all went wrong. But just to explain then is that money that was taken out was then the additional compensation that had to be taken out in order to
Where is it gone?
Well, that value doesn't exist anymore. So it hasn't really gone to anybody. The Reserve Bank on Sunday said, listen, you had, let's say, exposure of 100 Rand to able on the senior debt. From tomorrow, you'll basically only have 90 Rand. And that's all that happened. That money just is the same as with the valuation of an equity price. The value just became zero. So all of that was just gone overnight.
People feel like they've been robbed.
Absolutely. And I think with hindsight, there's a lot of fingers that can be pointed, but it happened to Able. It could have happened to some other companies as well. But I think what we're seeing is the aftermath of a bubble in the unsecured and the micro-lending industry.
This is all fascinating, but it has a direct impact on you, on your money market account, on your pension fund, ultimately. Stephen Nathan, Chief Executive of 10X Investments. You're an index tracking business. Aren't index funds more exposed than managed funds at a time of uncertainty like this, Stephen?
Bruce, no, I think they're less exposed because an index fund follows the index. So at 10X, we track the top 60 shares by market value on the JSE. And African Bank is not in the top 60, and it hasn't been in for some time because
2 years ago it was there. It was number 39. It was worth 30 billion Rand on the JSE.
That's correct, but that was 2 years ago. So once it drops out of that, then as an index fund, it's rules-based. So you have no discretion, and you just follow what the market is telling you, which is that the business was under pressure. So from a 10X perspective, where we track the top 60, it's not in our portfolio, so there's no equity exposure at all. And many of the index funds in South Africa focus on the top 40, so it also would not be in their funds. As you say, maybe 2 years ago, the performance wouldn't have been that good. But it's the active managers that are holding the vast majority of African Bank.
Now, I mean, we've seen the exposure, we've seen the confessionals come out. Coronation came out with an extensive confessionals to how humbled it has been through the collapse of African Bank. It's revealed that it sold 150 million shares as the bank was imploding. It clearly had no intention of following its rights again. Then we saw that Alan Gray had bought up a whole chunk of African Bank in the hope of capitalizing on the so-called good bank when it's relisted so that it can participate in the recapitalization of that good bank. Are there any other significant exposures that we should be aware of in that space?
Well, there definitely are some funds. I mean, one that comes to mind is the Momentum Value Fund, where as at June, they had just over 10% of their fund in African Bank. So if you are an investor in that fund, you're taking a very significant risk against the benchmark because, as I mentioned, African Bank in the all-share index, which is the benchmark of that fund, is minuscule. I mean, I don't know offhand what it would have been at that point in time, but certainly less than 1%. So if you've got 20 times exposure to one single counter, then you're taking significant risk. And I would expect that fund to take a very large loss. I mean, you've lost about 90-something% of your money, depending on where you entered. And unlike the bonds, which you spoke about, there's a 10% loss there. Here you've got close on a 100% loss.
No, I mean, I'm lost for words at this particular point, as you can see. How does a fund manager take a 10% exposure to a single stock the size of African Bank? That is not an investment decision. That is called gambling, the last time I checked my dictionary.
Yeah, I would agree with you. I mean, if you look at the benchmark is against the all-share index, so the investor believes that they're getting exposure to a fund that's going to have relatively similar performance, not exactly the same because the fund manager does have discretion. But when you're taking that level of risk, then you have to question where the risk management in the company is, who's monitoring this, what kind of risk is acceptable, what kind of underperformance is acceptable. And just on that fund, the 3-year performance to June, which is before the large fall in African Bank, the all-share index had returned 80% cumulative, and this fund had done 15%. So even before that,
1.5 or 5.0,
your
sorry?
performance, 1.5.
Okay.
So even before that, you are nowhere near what the all-share index is giving you.
But this fund also had quite a colourful name, didn't it? I mean, it's the value fund, but it was called something else, wasn't it? The Cataclysm Fund or something?
I'm not sure, but it is under the mandate which says it's an unconstrained fund, whatever that may mean.
Okay, unconstrained. I was called a cataclysm, unconstrained. Well, if you're going to go buy into a fund like that, and the word unconstrained is there, is that sufficient health warning for anybody who puts their money into a fund like that?
I don't believe so. The fund that's called something like the Momentum Value Fund, and the benchmark is the all-share index. The fund manager is part of a team that is based in what they call the unconstrained strategy. But I wouldn't imagine an investor or a financial advisor would take note of that. They would take note that I'm buying a value fund. Pretty much people know that a value fund tries to buy cheap shares, and I'm getting roughly exposure to the all-share index.
I'm gobsmacked. I'm not often gobsmacked, Johan Gouws, but I mean, here we've got a situation where it comes down to the responsibility of the asset manager. Now, are there rules that govern what exposures you can have in a fund to a single share?
I think that's exactly the point we need to discuss. First of all, for a pension fund, for example, there will be Regulation 28 rules that you need to comply with, and that would limit the asset manager in terms of how much exposure you can have to equity as an asset class, how much you can invest offshore.
This is a value fund. It's a unit trust.
Right. So there's just the first level now is the Reg 28, and it will also regulate in terms of how much exposure you can have to a certain interest-bearing instrument with a certain credit rating. So that's the first level. Then some of these pension funds would have been using collective investments or unit trusts. And there's also some rules that apply in terms of how much exposure can an asset manager have to one single stock as a percentage of the issued shares. There's a couple of things. Now, in this case, it didn't obviously preclude an asset manager of having a large exposure to a stock that's actually relatively small.
Because every asset manager will have what they call a mandate. Yeah. We are allowed within our mandate to do X, Y, and Z.
And I think what's going to happen now, there's going to be a little bit more of a sensitivity and a focus by trustees of pension funds to have an understanding of what that mandate actually says that they've given to the asset manager, and that's where the asset consultant, I think, will have to play a big role in just making sure, that everybody understands what this fund is allowed to invest in and not. But I think just the other thing, in terms of the pension fund industry again, other than the regulations that you've got, And I'm not talking away what's happened with Able and the fact that some asset managers had too much exposure, but the fact is that most of these funds are multi-asset class portfolios. So you do have diversification in terms of the asset classes, the geographic areas, the currencies, etc. And then also within asset classes, you've got diversification like inflation-linked bonds, all of that. So you've got
all of that is fine, but surely we have to have a level of constraint, even in unconstrained portfolios. But if I had 1,000 Rand invested in the Momentum Value Fund last Monday, how much have I got today?
Well, you basically have to take that 10% out, so now it's 900 Rand.
It's 900 Rand. That's a significant knock, Stephen Nathan, in a single week on my entire investment, isn't it?
Without a doubt. I mean, as you mentioned, I mean, diversification is the first principle of investing, is that you must own diversified portfolios. Even if it's a single asset class, you mustn't have concentration risk.
Absolutely right. I mean, that concentration risk is there for everybody to see. And it comes as a warning, doesn't it? I mean, in terms of the stuff we buy, the stuff we're advised to buy. And just because you come to me as an advisor, for argument's sake, and say to me, you've got to get this value fund. The Sam Hooley guy who runs the value fund on behalf of Momentum, great track record, wonderful fund manager, years of experience, you've got to follow this guy. You make the investment decision, it's your money that is lost.
Yeah, and in the end, I think also financial advisors, I think they will also be put under spotlight a little bit more in terms of, do they understand exactly what funds they are suggesting to their clients to invest in, be it their discretionary money, be it their retirement savings, and then at the institutional level, then also for the asset consultants being able to advise their institutional clients on that.
Do we have, as consumers of this value fund, let's assume we put money into it, do we have any recourse at all?
If they were basically, if that fund was invested according to its mandate and the supplemental deed, unfortunately not. It will then become an advice issue maybe.
And this is manna from heaven for you, Stephen Nathan, because you then go back and you say, you see the index never lies.
Without a doubt. I mean, it's been proven that the index is the better way to invest in the long run compared to most active managers. But the point here, I think, Bruce, that you mentioned, it's really a question of risk management. The mandate of a unit trust to track to benchmark against the all-share index, what on earth does it mean? Because I think your question is exactly right. Do investors have a recourse? Because you can look at the performance over the last 3 years, even before the Able meltdown, and this fund has very little, if any, correlation to the all-share index. So what is the mandate? I have no idea what actually the mandate is when the results are nowhere near what the benchmark is.
There we will have to leave it. Johan Gouws, the head of Absa Asset Consulting, and also in our Cape Town studios, Stephen Nathan, Chief Executive of 10X Investments. Fiery stuff, and a health warning that no matter what it is you buy, ultimately it's your money that's lost when it goes pear-shaped. So it's really important that you pay attention to the small print. Thank you for watching. There'll be more tonight, tomorrow. Till then, good night and goodbye.